Fannie Mae is now predicting sub 6% mortgage rates by the end of the year. And although last week mortgage rates climbed 0.15%, not all is lost, as we also saw the spreads are improving, which will be very important to getting us to those sub 6% rates, as I'll explain here in a minute. Housing inventory, new listings data, and mortgage rates all rose last week. But the bigger story is that the number of homes having price cuts every week is decreasing. And unless something changes, we're on track to break below last year's weekly price cut low. This is important because the number of homes having price decreases is a leading indicator to where prices are headed. The number of people applying for mortgages increased for the 7th week in a row, showing that demand is coming back. All signs are pointing to an increased demand and an early spring market this year. We're covering all of this and much more in today's weekly update. My name is Michael. I'm a real estate agent here in the Dallas area, and every Monday I do a weekly update covering all of Dallas and Collin counties. We're looking at trends, we're tracking mortgage rates as well as mortgage purchase applications, as that's our best leading indicator to what demand will look like 30 to 90 days from now. We're looking at things like median list price, days on market, how many homes are having price decreases, and what's inventory looking like. And if you stick around until the end, it's my favorite part of the video, the top 10 ranked charts of both hottest and coolest cities and zip codes in all of Dallas and Collin counties. If this sounds like something you're into, make sure and hit the subscribe button. And if you're looking to move to the Dallas area, whether it's next week or next year, I'd love to connect. I've helped every one of these yellow dots find their little piece of Texas, and I'd love to help you too. Just call, text, or shoot me an email. All that info is in the description below. Okay, today is January 22nd, and let's see what the data is telling us. And if this is an old video, you can click the playlist here, and it'll take you to the latest weekly market update. First up is market news. This week, we're talking about the spreads. What are the spreads? Why do they matter? This is a fairly complicated topic. I'm going to make it as simple as I can. What you need to know is, historically, on average, mortgage rates are usually only 1.7% higher than whatever the 10-year Treasury yield is. Ever since COVID, however, mortgage rates have gotten as high as about 3% above the 10-year Treasury yield, meaning that right now, mortgage rates historically are about 1.3% higher than they should be. Why is that? Because investors who are lending for mortgages in the form of buying mortgage-backed securities have two options. Option one, they can buy bonds, for example, 10-year Treasury bills. They'll know the return they're going to get, they'll know the time frame they're going to get it in, and this is considered a zero-risk investment. Or option two, they can buy mortgage-backed securities. Or you could think of this as they will lend money for people to get mortgages. But when lending money for mortgages, there are risks. Whereas if they just buy bonds, there are no risks. So in order to offset those risks and make it worth the investor's time to invest in mortgages instead of bonds, they will only do so for a higher return. One big risk we've been facing the last few years is people refinancing. Everyone who got a high mortgage rate last year is hoping to refinance to a lower rate this year, which means if you're the investor who lent them the money for the loan last year, if they refinance this year, your income stream is gone overnight. So because of this increased risk, investors have been charging a higher rate in order to compensate for that increased risk. Another big risk that happened last year was that big scare that the banks were going to run out of money. That too led investors to require a higher yield to compensate for increased risk. But to make it even simpler, in general, just think. In times of economic uncertainty, the spreads will get worse. So if you look at this chart, this shows you how bad the spreads are and how rare it is that this happen. So all of these gray bars, you can see here, that is over 200 basis points. That's over 2% higher that mortgage rates are above the 10-year yield. So you can see for the most part, we are less than 2% higher. And again, the average is 1.7%. So all that to say, we're in one of these gray periods. You can see it right here. We are well over 2%. We're closer to maybe 2.75% today. But just know that eventually we get back to one of these under 2% periods and probably back to the average of 1.7%. But when will spreads get better, and why does this matter? Well, presumably now that the Fed is done with rate hikes, that should lead to more economic certainty for investors, and over time, the spreads should start improving. Here's why it's super important. Even if the 10-year doesn't drop at all from here, and all that happens is the spreads go back to the normal average of 1.7%, you would be able to get a mortgage today of about 5.6%. Again, without the Fed dropping rates at all, if spreads were normal today, you'd be at a rate of about 5.6%, which brings me to the good news. If you watched my yearly housing market prediction video that I did at the beginning of the year, I said this was my range, these two black lines, but I allowed for a deviation of where these green lines go to about 4.25% on the high end, about 3.25% on the low end. But I also said this number would correspond with a 7.25% rate. That was assuming the worst case of spreads remaining around 3%. Well, what we saw last week was we got all the way up to about a 4.2%, but mortgage rates only got to a 6.92%. So we almost hit the top of my prediction range, and we were nowhere near a 7.25%. That means the spreads are much better than a 3%. And again, if this trend continues of the rates improving, we could get to sub 6% mortgages without the Fed even dropping the 10-year any lower. Okay, moving on, let's start with national housing inventory. This week we had our second increase in a row, although it was just 1,191 homes for sale in the US. However, it's nothing to get excited about yet. If you look at this chart, this is our small increase over the last 2 weeks. This actually corresponds to this flat part last year. So we're in these exact same weeks, and we can see what happened after these weeks last year was inventory continued to drop all the way until April 14th. Though historically, inventory should bottom around now at the end of January to the beginning of February. So it's not impossible that we could actually start climbing from here, but it's just too soon to tell, again, especially since we had the exact same pause this time last year. The one huge difference is at this time last year, at the end of January, rates were dropping. They got as low as 5.99%. So rates are not dropping like that this year. So it makes perfect sense when rates were below 6% that inventory would all get eaten up. We don't have that this year. So the hope is that if it does continue down, it will be at a much slower rate than what we saw here. And we're hoping that the bottom will get as close to the end of January, early February as possible, because that means we're returning to a more of a normal market. Now let's look at new listings. More good news here, though not incredibly good news. This is the number of new listings hitting the market every week. And as you can see, we are above, all year we've been above the previous 2 years. We're up to 44,244 homes were listed this week. That is up 1,488 homes more than the corresponding week last year. So not a huge margin, but again, we've got to start somewhere. And the hope is that we're eventually going to blow these last 2 years out of the water and have way more new listings coming on, and inventory will rise, and then things will get easier for buyers. Then the last thing we cover nationally is the number of homes having price decreases every week. Looking at this national chart, we're at 31.4% of homes having a price decrease, down from 34.7% this time last year. And this was the biggest leading indicator that nobody was talking about, that home prices were not going to drop last year. If you're going to have a price crash, you'd see it start with an increase in the number of homes having price decreases every week, not a decrease like we saw. And we're going to look at all these same numbers in our local markets here in a minute. But as of now, looking at this chart, the number of homes having price decreases will probably shoot below the low of last year, which again would suggest housing prices are not going to come down. If you want prices to drop, you need this number going up. Okay, moving on to mortgage rates. Last week we started at a 6.77 and we got all the way up to a 6.92. But the good news, as I already said, we tested the upper range of my prediction range for the year. And so far, if we look back at the 10-year, it looks like that was rejected pretty hard, and we're already almost back to my 2 black lines, which is where I think we're going to range for the year outside of these deviations that I drew in for you. And this green line is not a prediction of when these things will happen. It's just I think these are the extremes of if it goes outside my range. And so far that has held true, as this was rejected. We closed at a 4.15 almost, and we're opening back down at a 4.1 almost. So it's holding true so far. Now, regarding mortgage purchase applications, again, I see the number of people applying for mortgages as demand. More people applying, that means more demand 30 to 90 days from now. This is not immediate. We're going to see it in the next few months though. This week we saw a 9% increase in the number of people applying for mortgages. But what's even more encouraging is for all the weeks we're tracking, this makes 7 weeks of positive growth. Okay, before we move on to the local market data, if you're considering buying a home in 2024, 2 things. I'm now doing a weekly home buyer webinar. This is for anyone thinking of buying a home in the DFW area in 2024. If that's you, click the link below and sign up. And there's also an option where you can watch a replay. And number 2, I've developed a max affordability calculator. This will help you very quickly and easily get into the ballpark of how much home you can actually afford today based on today's rates and your personal financial situation. It'll give you a few different options to review, and it takes into account everything all the way down to your tax bracket. It's completely free to you. Please take advantage of it. If you're interested in that, you can see a walkthrough video of the calculator here next. Okay, now let's look at the local markets. We always start with the MLS data, starting with Dallas County. We had 228 closed sales in the last 7 days. That's 79 more than last week. 281 under contract, that's exactly the same as last week. 389 homes listed, that's 34 less than last week. And of the homes that closed, 36 were immediate sales, meaning they contracted within the first week. That's 4 more than last week. And in total, there are 1,777 homes either under contract or in pending status. Now moving on to Collin County, there were were 154 closed sales. That's 14 more than last week. 156 went under contract. That's 16 more than last week. 311 new listings. That's 8 less than last week. Of the homes sold, 32 were immediate sales. That's 4 more than last week. And in total, there are 1,450 homes either under contract or in pending status. That's 66 more than last week. Okay, let's move on to housing data. We're starting with Dallas County here, and if you've ever seen my videos, you know I use the Market Action Index. It just takes all of this information, puts it into one easy to read graphic. Anything a 30 or below is a buyer's market. Anything above that, we're asking how much of a seller's market are we in. We are still, as we have been for a long time, at a slight seller's advantage. And as you can see, ever since November 10th, we've just been around 42. So it doesn't look like we're going to get any cooler than a slight seller's advantage, which again is a seller's market. No huge changes here. I think the big point is that it doesn't look like things are heading down from here. Median price of new listings has stayed within this range. Median list price has been firm for several weeks. Median days on market has been flat as well at 56. The number of homes having price decreases did drop early, and it's been pretty flat around that 35, 36 number. Inventory, just like we saw nationally, right now is in a bit of a lull. We're going to wait in the next few weeks and see if it continues down or if we've actually seen a bottom, which we would hope so. But all that I'm really seeing in this is that things are not coming down. Historically, January is the bottom of the market for demand, for prices, for everything. So from here, we should be moving up. The market should be getting hotter. Next, we want to look at Collin County, and Collin County tells a bit of a different story. Collin County jumped early. Their bottom was actually like December 1st, and they've been getting hotter ever since. So they're up around a 45, which is a strong seller's market. But some very important things I want to note. Collin County has a ton of new construction, which means this data is going to be a little bit different to Dallas, where most of the homes already exist. But you can see the median list price ticked up a little, but the median price of new listings went up quite a bit, 30,000 this week. That's just 1 week. We need to wait and see if there's a trend. But I see that, as well as I see 4% of the homes are having price increases. The median days on market also saw a significant drop. We're all the way down to 35. The number of homes having price decreases is at 29, which is well below the national average. So what all of this data is telling me is that in the new construction market, these builders, because these builders, they get the data in real time. What I get weeks later and show you, they can see today in the form of how many people are showing up to their models, how many people are getting approved every week with their lenders, and how many of these homes that are never listed on the MLS are getting contracted. So when I look at this, what this is telling me is that the builders are seeing a strong increase in demand to the point where they're increasing the price on 4% of their homes. They're increasing the price on their new listings. And you can see that supported by the number of homes having price decreases in Collin County is dropping well below the national average, as well as the days on market. So Collin County is telling quite a different story to Dallas County. And what this tells me is if what you're wanting is new construction in Collin County, you should not be waiting at all. If builders are already increasing their prices because they see enough demand for that, you can count on incentives to get smaller and smaller moving forward. So if you want to buy new construction in Collin County and you think you need to wait for some reason, you're going to be competing with more home buyers as the spring market gets hotter, and already builders are seeing enough evidence to increase their prices. So please, if you're buying in Collin County, don't wait. Okay, now we're moving on to my favorite part of the week. This is the top 10 ranked charts of the hottest and coolest cities and zip codes in all of Dallas and Collin County. And these are ranked using that same market action index number. Remember, 30 or below is a buyer's market. Anything above that is how much of a seller's market are we in. So what happened this week? Coppell and Carrollton remain the top 2 spots. Louisville heats up one. Plano cools off one. Grapevine jumps onto the list out of nowhere all the way up to the number 5 hottest city. You can see it's curving up nicely here. Big jump this week for Grapevine. Richardson heats up 2. Duncanville remains in its spot. Prosper cools off 3. Allen remains in its spot. Sachse cools off 4. And McKinney got knocked from number 10 all the way off the list this week. Now we like to zoom in on specific zip codes. The absolute hottest zip code is Plano 75023, followed by Carrollton 75010, Carrollton 75006, Louisville 75067, Coppell 75019, Plano 75024, Louisville 75077, Irving 75063, Frisco 75035, and Garland 75042. So these are the hottest cities and zip codes in all of Dallas and Collin County. Now we're moving on to the absolute coolest. Looking at the coolest cities, Van Alstyne, Leonard, Whitewright, and Ferris all remain in the bottom 4 spots. Of course, Van Alstyne and Leonard are officially buyer's markets as they're below 30. Then Seagoville cooled off 1, Nevada cooled off 1, Balch Springs heats up 2, Farmersville and Rockwall remain, and Red Oak knocks off Anna for the number 10 spot. This means it's the hottest city on the coolest cities list. Then looking at specific zip codes, the absolute coolest is Van Alstyne 75495, Leonard 75452, Dallas 75203, Whitewright 75491, Dallas 75204, Dallas 75212, Ferris 75125, Rockwall 75032, Seagoville 75159, and Nevada 75173. That's it for this week. Once again, if you're looking to buy or sell in the Dallas area, call, text, or shoot me an email. I'd love to connect. Thank you for watching. I'll see you in the next video.